looking at areas that have low infrastructure now and focusing more on the incentives that those markets and those communities will bring for building infrastructure in the area to run these tech companies. And so, we've got portfolios in a number of target cities that these tech companies have identified as where they're moving to build infrastructure, and it's taken a huge boost to our real estate portfolio there. And so, real estate becomes a great opportunity, as it always has during times of conflict. You can go back to World War I, World War II, leading up to those conflicts. Banks were struggling to make loans. The cost of a mortgage was unaffordable. And that's when, banks came out with a new product, a 30-year mortgage. There's a good likelihood that banks are going to use this conflict now to justify the 50-year mortgage, and we're going to see that sooner than later. And so, you've got to get creative, and creativity does not lie in your traditional stocks, bonds, and mutual funds unless you're positioned in the right ones going into a time of conflict like this. But as you said, we're also going to see the impacts of inflation and what it does to gas prices. I was actually on TV and a radio interviews today and talking about, number one, what does this conflict do to China? We see China getting extremely frustrated and aggravated that we've entered into the conflict because ultimately what we've seen is Iran has cut China off from importing or exporting from Iran into China their oil already, and so that's got a huge impact on the Chinese market. And rest assured, Trump knew that going into this conflict, and he was hit with an adjustment to the tariffs that he had made, and was going to have to look at different ways to handle accomplishing his agenda, both in the Middle East and in Eastern Asia. And so now this conflict is one way to start squeezing China and get them to move in the direction that Trump ultimately wants them to do so. And so, now is the time to be watching, as we've talked about, that market correction that's coming, and we're seeing it. Last week, I think we saw a 1% adjustment, and again, as you mentioned today, we're going to end at about 1%. And both those numbers are significant numbers at a roughly 50,000 Dow Jones. And so a large correction like that early on is the indicator of what's more to come. And so now is the time to start moving chips off the table and into some of those physical assets like you were talking about, real estate, gold, silver, and so on.
Yeah, I think to give some perspective about the oil, about a fifth of global oil is shipped through the Strait of Hormuz. It's a huge amount. It's a very critical artery for energy. But to your point, they've already been under sanctions on shipments to the U.S. But preventing that to China could actually have a big impact to some of the markets in Asia. I think closer to home, elevated equity valuations definitely leaves less margin for investor disappointment. You mentioned AI. That's especially true around all of the enthusiasm that we're seeing around AI, which clearly is beginning to moderate. It's been, as we've talked about in prior episodes, a big growth factor for the Magnificent Seven. The overall weightings as it relates to AI has been severely capitalized as it relates to AI stocks. But I would say overall, corporate earnings and margins are still strong. Obviously, we have yet to get to the quarterly earnings reports, but it does provide some cushion to the underlying markets. But I think it does reinforce that discipline over reaction is really critical in markets like these. And I was surprised when we talked to investors and you explain that if you have a 10% drop in your portfolio, it's going to take a lot more than a 10% gain to get back to even, right? It's going to take a 12 or 15% gain, and you can do the math depending on the amount of the drop. So it is also very interesting as it relates to inflation.